Hello and welcome to Portfolio Matters. Thank you for bearing with us in our disrupted holiday schedule, but Stuart Owen and I are here. I'm dialing in from the Lake District. But before we get into it, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do you have for us this week, Keith?
Thank you, Stuart. Well, news this week. The Inflation Reduction Act, 369 billion of new spending has passed the Senate. And I find it ironic that you can be claiming to spend 369 billion and bringing down inflation, but Joe Biden seems to think he can. The big news this week was US CPI, which missed expectations and came in at only 8.5%, triggering a bit of a risk-on rally in the markets. UK GDP numbers were disappointing and showed the UK economy contracted in the second quarter. And finally, the drought continues in Europe, with the Rhine now falling to critical levels, which will stop cargoes going upstream. And this is a map of the Rhine, and the measuring station is here at Korb, which is down from Frankfurt, Stuttgart, Mannheim, Strasbourg, and as of yesterday was due to hit 40 centimeters, at which point barges just can't get upstream. That is going to cause a lot of disruption to European supply chains. For example, Southern Europe, Southern Germany, gets a lot of its diesel by barge from Rotterdam and Amsterdam and will suffer from a lack of diesel. Okay, moving on to this week's economic data, and it was a light week, thankfully. So we had US CPI numbers, which massively missed expectations. So in June, the number was 9.1% and was expected to stabilize at 9.1%. It fell sharply to 8.5%, and the markets took that very well. Core US CPI, however, was unchanged. We also had the latest US Michigan survey of US consumers, and numbers were quite resilient. So the core consumer sentiment number in July is 51.5 and is expected to fall slightly to 51.3. Instead, it bounced back to 55.1. Now, these are still very poor numbers, but better than had been hoped. The current conditions index, however, slipped substantially. So US consumers seem to be feeling slightly better about the future, but not so good about right now. And their inflation expectations, the 1 year expectation came down slightly, but the 5 year rose. So a mixed picture. In Europe, industrial production actually grew in June, which beat expectations of a small drop. So the European economy in June was quite resilient. UK industrial production in June fell by 0.9%. Now, we also had some quarterly numbers, all of which were quite interesting. In particular, non-farm productivity in the US fell again in Q2. So if you think of GDP growth as being a function of productivity growth, so economic wealth is productivity, then the US is actually getting poorer currently. UK GDP growth for the second quarter came in at minus 0.1, and GDP growth year on year slowed to 2.9% in the second quarter. Also, Reminder that the construction sector leads the economy, and construction orders in Q2 in the UK contracted by 12% year on year. Now, trading economics have consensus expectations that it would fall 88%, which I think must be a bad number. But anyway, 12% is still quite a substantial drop. Stuart, some charts.
The NFIB Business Optimism Index, which I believe is for small independent businesses, looking very bleak indeed, at levels lower even than the COVID pandemic, registering 90 on this measure. Not very good.
But ticked up a tiny bit.
Yeah, I think you need a bit of a microscope to see it, but yes, you're right. The US IBD TIP Economic Optimism Index, that's a new one actually. I'm not so familiar with that, but showing a similarly bleak picture of very little optimism around. The Michigan Consumer Sentiment Survey, this one I think has got a much better track record. I believe it's been rather predictive of recessions in the past. Again, a bit like some of the earlier charts, that there has been an uptick, but basically is still at very low, very weak levels. The Current Conditions Index, similarly, a rather bleak picture. Numbers there are as bad as they've been in about 15 years.
Yes, and I think actually that's an all-time low, because that's the previous low was the Great Financial Crisis.
The Michigan one-year inflation expectations has ticked back down now to about 5%. Very difficult to know what to make of these numbers all the time, how much they are led by the news. But for what it's worth, a positive development with expectations rolling over a bit. The 5-year inflation expectations have remained at about 3%. Again, I don't really know the sample size and where these are really sourced. It's a rather jaggedy series, but I suppose the Fed wouldn't be too unhappy if it turned out at 3%, especially given, ironically, was it about a year, 18 months ago, they were talking about average inflation targeting so that they could have higher inflation to make up for the previous low inflation. Well, they got what they wanted.
Yes.
US CPI coming off a bit, as Keith highlighted at the top of the show, still very elevated level, a bit above 8%. And the core CPI has also come off a bit, pretty much bang on 6%. But have a look at the chart. I mean, that is a big step change compared to the numbers which average pretty much around 2% from 2000 to 2020. So just emphasizing what a shock we've been through.
Yes, we have a couple of special sections on US inflation coming up.
US PPI coming in now at about 10%. Probably worth highlighting the comparison with some of the European stats there that I know Richard has been pointing out in previous shows of 20 and 30% PPI numbers in some European countries. Now, this was an interesting chart. This is looking at June and July job creation by different type of industry. And the creator of the chart was at pains to point out that the biggest turnaround was in the US government payroll, which, having fallen in June, swung to a big recruitment drive in July.
Yeah, so last week we talked about the July jobs report and how unexpectedly strong it was. And it's true that there was job creation across pretty much every sector, but it's only as strong as it was because the US government was hiring so well.
I'd really like to see that historically, to know how big 57,000 is in a time series. I'm always somewhat skeptical that some commentators like to bash government per se. Well, it may or may not be efficient recruitment. It depends how those people are employed and what they do.
Yeah, you also wonder how seasonal this is. National parks, etc., may well need seasonal workers.
US initial jobless claims, very much the story that we've been talking about over the past few months of a clear turnaround, but it's not a sharp increase in jobless claims, but it does appear to be that the trend is now pretty steadily upwards. Continuing jobless claims, a similar picture, but seemingly on not quite the same scale. So continuing jobless claims of about 1.4 million. The US 30-year mortgage rate, obviously this is a key issue we've been speaking about in the past couple of months, given the impact of the housing cycle on the business cycle. And there's been somewhat a bit of a tempering of the big increase in mortgage rates. Having hit 6%, they've come off a bit.
Yes, but still they're double last year's. So
Yeah.
in combination with 20% US house price inflation, that has massively affected affordability in the US. We have some charts later on showing the decline in the number of houses being sold.
UK GDP growth, this is the quarter-on-quarter data. And basically, you need a microscope to see much change. Very little has happened in the past quarter. Converting that into an annual number. Now, is this nominal, Keith, rather than real? Because we're showing 2.9% here, which somewhat surprised me.
I'm pretty sure this would be real.
Ah, well, in which case, not too bad. Though I do note that it's comparing itself to, of course, 4 quarters ago, which was itself being compared with 4 quarters previously. So I don't know whether there might be some sort of base effects still to wash out the system there.
Well, it's a lot of the strong GDP growth we had last year was definitely due to base effects from the pandemic. You'd hope that that's kind of rather washing out now.
UK construction orders year on year, after a brief burst of strong numbers earlier in the year, that's now turned negative. EU industrial production month on month, not too bad. I mean, given all the issues with energy costs, this number doesn't seem too bad to me at all, coming in at 0.7%.
But that is the number for June. And I think really the energy costs started to seriously hike in July. So I'm expecting the July number to be bad.
China inflation here, and now admitted to be at about what's that, about 2.5%, 3%. Not particularly out of its historic range. China PPI has come down a lot, from about 12% earlier in the year to a bit under 5% now. So in summary, US inflation has moderated from that recent peak, but remains well above the 2% target. US consumer sentiment has bounced from very low levels, so it's bad rather than very bad. UK GDP growth fell in Q2, and industrial production, as we've just been talking about, has been surprisingly resilient, but it seems difficult to believe that will continue later into the summer.
Thank you, Stuart. On to one chart, and thank you very much to our Discord member, Ali Broyd, for sending me this. And this is US productivity growth by sector since 1950. And I found these numbers extraordinary. So agriculture has been extraordinarily productive, and the output per worker has increased 16-fold. But if you look at mining and construction, there's been very little change indeed. Now, the way you measure productivity is as the residual of GDP growth after accounting for capital and labor. So in order to get more GDP out, you can either increase the amount of labor in the economy, so get more people into work, increase the amount of capital, i.e. machines in the economy, or use those two more efficiently. Now, one thing that productivity calculation ignores is inputs, such as land or raw materials. So in the case of construction, if land is becoming more scarce and you're building smaller homes, then if the amount of labor and capital going into building those homes is the same, but they've got a smaller footprint, productivity declines. Similarly, in the case of mines, if the concentration of minerals in the mine is depleting, then you're putting in more work to get out less, and your productivity is declining. In the case of mining, we know as the best ores become depleted, then mines are working on more and more marginal concentrations of metals in the rock. And so you're seeing declines in the productivity of the mining sector, which you can see in the grey line second from the bottom. But what is really interesting is in the last couple of quarters, we have seen declines in overall productivity for the US economy. And that means that US economy is getting poorer.
Keith, I believe that there's also an effect whereby at the tail end of a boom, when you're recruiting more and more people into more and more marginal jobs, then obviously aggregate wages are doing well, but your marginal increase to productivity is getting weaker and weaker as you're sort of recruiting more and more people who are previously sort of not considered worth the job.
Yes.
So I think that there could be a sort of cyclical effect going on there.
Well, you're right, Stuart, but what you should see is declining marginal productivity rather than negative productivity growth. And what we're seeing is negative productivity growth. So in part, I think that is explained by rising costs of materials and land. So if you think about the housing sector in the US, where we know that post-pandemic, the cost of timber absolutely shot through the roof. So you are then building probably smaller houses or more expensive houses, which are exactly the same as the houses pre-pandemic. And therefore, if you look at productivity will have declined. Your costs of producing the same house have increased.
Yes, I must say I had a rather wry, bitter smile when I saw that line on construction productivity, given that it's taken me 3 years to build a house. And I thought that I'd been clever by using an off-site manufactured construction system to get innovation and modernity on my side. It didn't really work out.
Yes, the thing about the construction sector is that really the construction methods are unchanged in 100 years. Very little has changed. So unless you start building lots of things prefab, etc., it would be difficult to see how you could improve productivity. And also there are some things in which you don't want productivity. I mean, how do you raise the productivity of an orchestra? Get them to play twice as fast.
Good point.
Okay, on to inflation watch. Stuart.
Okay, well, we've already highlighted the US number coming in a bit lower than previously and igniting debates about whether that has peaked. Europe at 8.9% for July now, and I believe we've just tipped over from QE to at the tiniest bit of QT in Europe. I believe there's a chart on that later, which puts that in some perspective. Japan still at 2.4%, still obviously much less than the rest of the world, and still very much pressing on the QE pedal.
Yes, Japan is now the only major central bank that's still doing QE. Okay, now this week, because we've had the US inflation number, I thought I'd break up our sections on inflation. And the first one is what has caused inflation. And what's interesting is that the cause of inflation in the EU and the US are very different. So on the left, we have European inflation broken down. You'll see that a big chunk of it, over 40%, is energy, with service inflation, grey bar at the top, being only a small portion of overall inflation. Whereas if you look at the US, then service inflation, by wages, is a very substantial portion of overall inflation, with energy being much less. And although we had a weak US CPI number, wage inflation in the US continued to rise. Now, the Atlanta Fed's wage tracker actually rose sharply in July, which suggests that service inflation may become persistent. Although surveys are showing that wage inflation may be moderating, so that number may come down a bit from its current peak in coming months. But the fundamental cause of all this is the change in the working population post-pandemic. So the question is, why is the labour market tighter now than in 2019, when the number of employed in the US was very similar? What's happened is a lot of 55-year-olds plus have simply left the workforce. They've retired and are unlikely to come back. What that means is that there's now a much tighter labour market, because the same number of job openings are hunting for far fewer workers. And this problem is going to get worse, because when you look at demographics, the baby boomers who are now retired are a large cohort. When they leave the workforce, then subsequent cohorts are much smaller. And unless you massively increase immigration, then the US economy is going to end up short of workers. And that problem is actually exacerbated by the fact that female workers with young children are also not coming back into the workforce in the US, possibly because of the high cost of childcare. So what this means is that a lot of sectors are struggling to find workers and are paying up in the form of wages. That's why you're seeing high wage inflation. Now, we talked about quite a long time ago now, Pradhan and Goodhart's argument for the return of inflation in the coming years. One of their main arguments was that as the population ages and older workers fall out of the workforce, then the elderly population has resources and needs to pay up for the services of the remaining workforce. So you end up with a tight labour market and high wage inflation. Now, the counter argument to that is, why hasn't it happened in Japan, where you have similar dynamics? And they point out that deflation in Japan coincided with globalization. So Japan was essentially able to offshore a lot of the jobs which were previously done onshore, and therefore they essentially moved jobs to China. But now we're seeing globalization being rolled back. That is no longer possible, and demographics will lead to higher inflation in the future. So bottom line is, a lot of this inflation looks structural due to demographics, and will be difficult to avoid going forward. So the bottom line is, we may be entering a period of structurally higher inflation due to changes in demographics. Stuart.
So turning to another aspect of inflation, have we seen the peak in US inflation? So here's quite interesting disaggregation of the US CPI inflation, which basically suggests that some of the longer term pressures on inflation, i.e. from services, continue strong, whereas the volatile energy component is the part which has been producing the recent tapering and easing of inflationary pressures. So that would suggest we're very far from being out of the woods yet. And looking at different components of inflation, here we're looking at some data about whether the large changes we saw last year, the transitory, or as Keith would say, the transient elements of CPI, what's been happening to them? Well, if we look, for instance, at the infamous used cars and trucks price inflation, that's the top right chart, and we can see that has moderated an awful lot from about 40% year-on-year growth to getting close to flat. And the same picture is evident in car rental prices. Airfares, however, remain a big pressure upwards. So some have peaked, particularly the car-related aspects, but airfares have not. But that, however, these are the important components driving the headline. But I guess we're really concerned with the core parts. As we've been speaking about and highlighting before, one of the concerns that will drive those core prices long term is whether we get into a wage price spiral. And here the Atlanta Fed's wage tracker shows cause for worry, as that hasn't really topped out. We're getting those very big wage increases. As we've highlighted previously, a lot of this seems to be concentrated in less well-paid people, people being sucked in particular in the service, leisure, hospitality areas. Wage demand may moderate with changing inflation expectations. I think it's a rather sort of subtle, longer-term point. If I was cleaning a room in a hotel, I don't think I'd be too concerned about Michigan inflation forecasts. I think I'd be pushing for whatever I could get. But for what it's worth, this is the 1, 3, and 5 year ahead inflation expectations, which do all appear to have peaked and to be moderating at quite a level that I'm sure the Fed would be happy to see. Broad measures of inflation continue to rise, though. Here are some measures from John Authors at Bloomberg, looking at the various trimmed measures. There's the official trimmed in the white here, and the median price increase in the blue line, both of which show absolutely no evidence of having peaked and having rolled over. They're between 6 and 7% each.
Yes, inflation is broadening, sadly.
If we look at the core CPI inflation, the 3-month change annualized or 1-month change annualized, well, I would say that there's nothing particularly conclusive yet. The 3-month change still looks at around 7%. The median inflation picture, I think, also looks rather worrying. Again, looking at the orange line here, the 3-month change annualized, that hasn't come off at all. So no real evidence of moderation there yet. And another way, of course, of looking at prices is the relative change of sticky prices, which are difficult, operationally awkward to move, versus those which are much easier to change at short notice. So here we're looking at the sticky prices, either the 12-month change or the 1-month annualized. And well, for instance, the 12-month change in sticky prices still looking well, very little evidence of that having rolled over. Obviously, the 1-month annualized is very spiky. It's come off a little bit just recently, but no real change in trend there as far as I can see. Month-on-month change in sticky prices has come off a little bit, as I was just saying, but it does remain pretty high. I think it would be unwise to call any top yet. I was reading something during the week suggesting that if there was no month-on-month change in inflation in prices through the rest of the year, we'd still end up with CPI at 6% at the end of the year. So there's still a long way to go. We might be moving towards 2%, but there's a big difference between falling from 8 to 3 and 8 to 6, if you see what I mean. Now, one long-term pressure on inflation is, of course, going to be rent. We've highlighted how important accommodation is to the US construction of inflation, where house prices are converted into an equivalent rent level, and rents themselves are directly measured. And here we're looking at the owner's equivalent rent year-on-year change, which is now well over 5%. And to me, that seems a surprisingly moderate number, given what we've seen in house prices and direct measures of rent. So the CPI rent component has only risen by 5.8%, whereas actual rents have risen by 12.4%. So I think we can expect that there'll still be a fair bit of momentum and lagged effects to come through in the owner's equivalent rent measure that feeds through to US CPI.
I think the way to understand this is if you imagine that there is a one-off 15% rise in all rents across the US economy, but all renters are on 12-month contracts, and every month 1/12 of them rolls off, then it will take a year for that 15% increase in rents to be fully shown in the statistics, because every month only 1/12 of total renters will report a 15% increase in their rental demands. So bottom line is the rent increases are already baked in, but they will come through slowly into the CPI statistics.
So nicely explained, Keith. And I think direct rents like that are only about a third of the owner's equivalent rent. And I think the other 2/3, which comes from a survey and analysis of how much people would let their own homes for, that of course is going to suffer, I would have thought, even worse lagging effects, as people don't really know what their house would rent for, and they're only going to slowly catch up with the changing reality in the market.
Yes, good point.
Now, having a look at a different aspect of inflation, this is small and medium-sized enterprises' output price inflation, where we're seeing some encouraging signs that the peak has been reached in terms of the planning for price increases. So smaller companies look to have implemented the price increases that they were hoping to, and there are going to be fewer of them in the future. And that appears to lead the official inflation statistic reasonably nicely. Now, this chart, I was flabbergasted to see, because it's making the case that the US government's response to the COVID pandemic loss of income was wildly disproportionate to the actual loss of income. So from this commentator, that's Florian Kronavitter, has calculated that there was a $200 billion shortfall to payrolls if you take the deviation of payrolls from their trend and then you annualize that. So 200 billion was the loss of income, and the calculations suggest that there was 2,900 billion of government support via stimulus checks, etc., so direct fiscal support, on top of which, of course, there were all the 0% interest rates and government bond buying programs as well, which I guess are a slightly different comparator. So I'm not sure whether that deviation from employment trend is quite the right measure, but my goodness, if it is even approximately correct, you can see where inflation has come from, which is a very, very strong fiscal response.
Yes, I like Florian Kronavitter, but I think he may have done a bit of double counting here, in that presumably the fact that damage was so low due to only a small loss in payrolls was probably in part because the government had done a lot of loans to support businesses and allow them to keep people on payrolls. So I think there's a bit of double counting here, but I think that the general idea is a good one.
Right, turning to other impacts on inflation. The chart here is looking at various commodity prices over the summer. And I think, as we're all pretty aware, copper, gasoline, aluminium, gas Well, this is US gas, I'm assuming, not European gas. Steel and soybeans in general have shown quite a downtrend since around May. So that could be expected to take the edge off some components of inflation. Another impact on inflation, of course, will be demand. And we show here a chart, again from Florian, looking at excess cash per household relative to pre-pandemic and breaking that down by income quintile. And the basic story is that the rich have kept hold of their excess cash, the poor have spent it and have now have less than they did pre-pandemic. So quite a distributional impact here.
But the middle classes, the middle central area of the income distribution would be 40 to 80%, still do have savings which they can spend if they so choose.
So talking of excess stimulus, when the economy rebounds, so will inflation. Now, the chart here, I think, is very interesting because I've been thinking more and more about, I think, what Keith has also been talking about recently, which is stop-go economics. And the chart here is the picture in the 1970s and 80s, where you can see an up-down pattern to CPI. And the case that was being put to me about stop-go is, well, let's imagine the Fed at the moment increasing rates. Not difficult decision to make at the moment. Unemployment's less than 4%, inflation's 8%. Right, we've got to raise rates. But what happens when inflation is coming down, the economy is weakening, unemployment is going up? It could well be that they take their foot off the pedal, that they don't like and can't bear the political pressure of rising unemployment, and that they then loosen before the job is really done on inflation, before inflation is truly squeezed out. And therefore, you might have to go through the cycle again. You might get, in 2 or 3 years, another cycle of rising rates and the same pattern playing itself out. So this, I think, is what people were talking about in the 70s and early 80s, at least, of stop-go economics. And
Yep.
if that does play out, then I think we could get the sort of volatility that Keith has been talking about in financial markets.
Yes, absolutely, Stuart. And this is what I'm expecting in the coming years, in that I think we now have structurally tighter labour markets in the US due to demographics, unless we tempt all those older workers back into the workforce, and they will have lost skills if they do come back, having spent a few years out. But primarily, there's still a lot of excess savings in the system. Now, right now, I think you could make the argument that rising prices, the rising interest rates from the Fed, and a lack of consumer sentiment, and later we have a chart on consumer sentiment in the US towards buying durables, and it's incredibly bad. All that is putting people off spending those savings. But when the economy bottoms, there's all that money still to be spent. And so I think you go back to an excess demand situation, inflation returns, the Fed again has to kill the economy. And so you get the same pattern we saw in the 1970s. This is really important because it's determines your asset allocation. Traditionally, you will say time in the market rather than timing the market. But if you're going to have very volatile markets, like we did in the 1970s, then the rewards to attempting to time the market are extraordinary. If you look at the performance of the UK stock market in 1973-74, I believe it fell 70% peak to trough, and then bounced all the way back in 74-75. So you don't need to get all that right, but if you get some of it right, it makes an absolutely enormous difference. Thoughts, Stuart?
You're making me worried. I was making the case last week for time in the market and sticking to my strategy, but I totally see the logic of what you're saying. I need to do some more serious thought on this because the standard recommendation is not to try to be cyclical, and I don't think many people have got quite your ability to turn on a sixpence and make a decision and implement it fully. So I'm nervous about getting into the cyclical decision game, but I mean, I do see the logic of what you're saying.
Well, it's something we'll be covering on a weekly basis over the course of the next few years, Stuart. So, you have a chance to think through things.
Well, and of course, given the little rebound we've had over the summer, it feels like, we've been given a second chance to get out. Anyhow, right, turning to the more familiar subject of market expectations of what the Fed funds will be. So here we go. Currently, our markets, we're at 2.5%. By September, 3%, November, 3.5%, December, 3.75%. So we are still tightening. And there was an interesting speech by Neil Kashkari the other day where he was basically saying, look, we are serious about this. We're not going to back off from raising rates and holding them there until the job is done on inflation. Obviously, we'll see if that actually comes to pass or whether the pressures from rising unemployment cause them to back off too soon. But for the moment, that was the Fed's public statement.
Yes, there are several Fed governors who've come out with quite hawkish comments in the past week. But also, I would highlight the fact that the Fed is also doing QT. And estimates are that that may add another 50 basis points in tightening. So, Fed is tightening.
Yes, I never know quite how seriously to take those comparisons of sort of QT withdrawal and equivalent interest rates. It seems to me a slightly different source of tapping on the brakes, and I can imagine sort of marginal projects or more properly marginal speculations in financial markets becoming unprofitable and having to be unwound from liquidity reasons and lack of availability of funds rather than the price of funds. Anyhow, inflation in the US does, in summary, are likely to be in the process of peaking, but the rate of reduction is very unclear. Year-to-date inflation in the US is 6.3%, and that can only return towards target if there are strong negative prints during the remainder of the year, which is unlikely. As I was saying before, if inflation was simply zero through the rest of the year, we'd still end up with a CPI rate of about 6% at New Year. And interestingly, we should think of inflation as being a reflexive process. If moderating inflation causes a revival in animal spirits and an increase in demand, then inflation will pick up again. There is a relationship. People are observing what's happening to inflation and rates, and of course, will change their behavior correspondingly.
Yes, thanks, you. Before we move on, actually, can I just return to your comments about QT and liquidity? And I agree that one of the prime channels by which QT works is in reducing liquidity. But that means that if you need funds, then you have to pay up for them. So your real interest rate increases.
Right. So the bottom line, let's not forget, inflation is at 8.5%. Wage growth is at 7%. These are not numbers at which the Fed is going to stop raising rates. Inflation is just too far away from target. So putting that together, rising rates, a bit of QT, very poor consumer and business sentiment, and the weak PMIs, well, it's quite surprising we've had such a bear market rally, and it's not a time to be chasing it.
Thank you, Stuart. Right, on to other inflation charts. Well, the ECB has actually started doing QT, which is surprising. And we have highlighted previously how they're now buying Greek and mainly Italian bonds and selling German and Dutch bonds. But overall, they've actually been reducing their balance sheet, though it is extraordinarily high. So the ECB owns Eurozone bonds, the equivalent of 80.9% Eurozone GDP, which is an absolutely enormous number, more than twice as much as the Fed owns of its own bond issuance. although Japan is the champion, it owns over 100% GDP of its own bonds. And if we look at inflation rates across the Eurozone, there's an absolutely enormous divergence, which suggests that the ECB is going to have a very difficult job. It's got one policy, it's got one monetary policy for some very divergent set of inflation experiences across the Eurozone.
Yeah, Keith, I thought that chart, that chart was fascinating. It reminded me of what an ex-colleague of both of ours was saying when the Eurozone was created, because at the time the argument was all about convergence, one big area, a bit like the US. But his point was actually, if you fix the exchange rate, you're going to encourage divergence, because the monetary policy might be the same, but fiscal policies, social policies, to some extent regulation, will be different between countries. So if you don't have the safety valve of a changing exchange rate, you're actually going to cause divergence in the economic performance of countries. And I think we can see some evidence of that here.
Yes, absolutely. And unfortunately, the adjustment mechanism for getting all these countries, their economies back into line when the exchange rate can't move, is the real economy. So if you, for example, Italian industry becomes uncompetitive relative to German, then you can't adjust the exchange rate. Factories have to go bust. And that will be very, very economically divisive and cause unrest. But it's been amazing so far how the countries of the Eurozone have been willing to put up with enormous amounts of pain to stay within the Euro. Look at Greece, they have suffered far more economic damage than during the Great Depression. And finally, further evidence that inflation may be peaking in the US in that online prices have fallen for the first time in 2 years. On to recession watch. Well, this is the Eurozone PMIs, and they all look absolutely terrible, frankly. In the US, reminder that one of the best leading indicators of a coming recession is the change in temporary unemployment, because temps are the cheapest people to fire. And so far, there's no evidence of a loss of temporary jobs. So, as yet, the labour market is not showing any signs of an imminent recession in the West. But home sales are falling and look set to fall further over coming months. A reminder, the housing cycle is the business cycle. And if we look at consumer sentiment in the US, which is very poor, then one of the main causes of poor sentiment is inflation eating away at people's incomes. So as inflation moderates, you could see a pickup in consumer sentiment. And I think we've already seen that in July, where I'll show you later, real earnings actually rose for the first time in a while. So worsening personal finances in the US are causing a big drop in consumer sentiment, and it's interesting to see how Republicans in particular are feeling very bad about the world. Globally, consumer and business confidence looks awful, though consumer confidence is much worse than business confidence. But if you look back to 2008, you see a similar pattern. Consumer confidence led business confidence, which makes sense because as consumers start delaying purchases, etc., with a lag, that affects businesses. And I'd also say that we're in the summer months, people have money saved up from the pandemic and they haven't been on holiday in a couple of years, so they're probably spending on holidays that they'd have planned for a while. We will see the true state of the economy once all that deferred leisure spending is exhausted, probably starting in September, October. Now, I should also add that all this data is from the June Michigan Consumer Survey and was sent to us by our Discord member, Richard Wilk. Thank you. But I think this is possibly the most important chart in this pack. It shows buying conditions for large household durables in the US. Essentially, it's fallen off a cliff. Price of durables has gone up. People's personal finances are falling. This is going to feed through to delayed purchases and slow down in manufacturing. And the same is true for houses. Higher house prices, higher interest rates mean that US consumers are not feeling good about buying a house. So the housing cycle is about to turn, it's turning down. And you can see that in the cancellation rate, which is spiking. So people who put down a deposit are subsequently cancelling home purchases. And we've talked about this previously, but inventories are rising. And as inventories rise, so customers then cut new orders. And the economic surprise index remains negative. Now, the Atlanta Fed GDP Now estimate for Q3 is just above 1%. Reminder, we've had 2 quarters of negative growth in the US. But futures curve is flashing a warning sign and it's inverted. So, bond market thinks that a recession is coming. Now, reminder, inversion tends to happen a few months, up to 18 months before the recession actually starts. But its accuracy is really very good. So the bond market is forecasting a recession. As I've discussed earlier, real wages actually rose in July, which may explain in part some of the rise in consumer sentiment from historic lows. And that recovery in purchasing power may be reflected in a jump in gasoline demand. Moving to the UK, this is the Bank of England's GDP forecasts for the next 2 years. And frankly, this looks really bad. The forecasting a recession that lasts the best part of 2 years, and they're forecasting, note, a strong rebound in Q3. And given the very high energy prices the UK is experiencing, I wonder how strong that will be, although it will be offset by strong holiday spending, as we discussed. Finally, this is Fidelity's business cycle tracker, which shows UK and Eurozone moving very close to contraction, and the US and Canada heading down as well. So in summary, all the European data looks awful. Expect a European recession, frankly, now. US consumer sentiment is very poor, with durable goods and home purchase intention very low. However, US consumers retain excess savings from the pandemic, and if their animal spirits revive, then so could the US economy, although that would then cause the Fed to have to tighten harder to get inflation under control. So there may be a bit of reflexivity over the coming few months. And on to the European energy crisis. Stuart.
Well, there's not going to be any good news here, is there? And we've all seen the headlines. Here's the German 1 year ahead power price. And I couldn't believe that the spike last December when it went up to 350 euros per megawatt hour, after which it collapsed back to more like 125. It's now at 450. It's simply remorseless, the logic of what's happening in the energy markets, and the squeeze is showing absolutely no sign of easing. Here's the French picture. I was talking about it before being asymptotic. Well, it's gone even more. Have a look at the picture. It's simply nosebleed levels. Keith has highlighted previously the issue of the low water levels in the Rhine affecting energy distribution in Germany. The other effect is in France, where the low level of French rivers mean that French nuclear power stations can't emit their hot water into those rivers, and hence output is being cut pretty dramatically.
Well, these are amazing numbers. So at this time of year, you'd be expecting somewhere about 900 megawatts being produced from French nuclear power stations, and it's at 158.
Yeah,
so a sixth.
Quite. I mean, previous to if you'd have known the origin of the crisis, you would have thought France would be relatively well protected with all its nuclear power stations. But here's something else to give a good kicking to the market. And talking about giving good kickings to the market, hydro more generally, not just to transport barges, not just to help cool down nuclear power station output, but straight hydro generation is also suffering from water levels. The top left here, Norway water reservoir levels, very important source of electricity generation in Norway. If they can't generate their own hydro, then they won't export what gas they have. Similar picture in Italy, Spain, and Austria. Talking of water levels in the Rhine, here's an update of the chart of moving diesel up the Rhine by barge, and you can see an absolutely massive spike. I'd also highlight this is priced in Swiss francs, so you've got to pay in hard currency as well. Having jumped from less than 25, it's now 261 Swiss francs per ton.
Yeah, and so this is from earlier in the week, and I wonder whether this is just completely out of date now and you just can't do it.
Yeah. And a nice little example of the impact on real people here. This is from Facebook, people beginning to post what their bills are going to be. This is an example of one guy, his bill is jumping from 210 euros a month to 1,160. And I believe, Keith, did you comment in previous episodes that there's some lag before European consumers are getting their bills being updated? Obviously, it's something in the UK which gets a lot of coverage, but that the noose is tightening now.
Yes, but also, Stuart, this hasn't hit yet. People are aware that this is coming down the pipe, but do you think they've adjusted their spending and started saving? See, I doubt it.
Yep, another real-world example here of a grandmother who is 88 years old on a pension of 1,300 euros a month. Her gas bill going up from 170 euros a month to 835. It's just going to be, well, something will be done. Obviously, people cannot get through that sort of squeeze. And German consumers are returning to medieval solutions to heat their homes. They are chopping down firewood, and this is a measure of searches for information about firewood. Another impact, of course, we've covered in the past is the impact of energy prices on fertilizer production. Here's a map showing various locations of closure of fertilizer production facilities pretty much across Europe. And as Keith has pointed out in the past, if you do this to fertilizer production, there's going to be lagged effects on, obviously, farmers' use of fertilizer and therefore on crop yields in the future. So in conclusion, we keep banging on about it, but there's a remorseless logic to the European energy crisis, and it's coming soon. Democratic governments will attempt to protect consumers through rationing and subsidies. Businesses are likely to be first hit. Voters and consumers will be protected, but it's not going to be easy for anyone, of course. So there's going to be financial stresses across the board, bankruptcies, producer price inflation. It's going to be pretty miserable. So we continue to expect to see the euro falling against other currencies, particularly, I guess, against the dollar. it's difficult to avoid the remorseless logic of what's happening in energy markets and its spillovers throughout the economy.
Yes, and I'd also add, I think the same is going to be true for the UK. If you think of a pub chain, then its electricity and heating bill is going to treble. Now, what's it going to do to offset that? Is it going to raise beer prices from already astonishingly elevated levels? In the UK, in London, cost of a pint is now £7. Are they going to raise it to 10? I think basically business will completely collapse. So I think a lot of businesses, not just energy intensive businesses like aluminium producers, the ones you normally think of, will suffer real declines in earnings from the coming crisis.
So investment implications, avoid both euro and GBP denominated risk assets, look to buy safe havens. The dollar, as we've been pointing out, gold should be, but obviously we've all been rather disappointed with the behavior of the gold price. And Keith would also be looking at government bonds as a classic place to hide during a recession.
Thank you, Stuart. On to the UK energy crisis. Now, we've been talking a lot about Europe, but I thought this was amazing. So this is a comparison of electricity prices across Europe in May 2022. And the highest electricity prices are actually in London, not in Eurozone countries, which you would think would be worse affected by the reduction in Russian gas flows. And this is the forecast for the UK Ofgem energy cap that's been put together using the futures curve. And these are eye-watering numbers. So last year, in winter 2020-21, the energy cap was just over £1,000. It's now forecast to peak in Q2 next year at £4,266 per household. Now, if you think a nurse earning less than 20 grand, how is that going to be affordable? It just can't be affordable. But if you look at the temperatures in UK houses over the last 50 years, you'll see that back in the 1970s, houses used to be about 10 degrees C. And we've since got used to houses being actually over 20 degrees C in the early 2000s. So one solution which will help will be to turn the dial back to the 1970s and the thermostat back to 10 degrees C, put on a jumper. Now, these are our interconnectors. We have gas flowing from Norway, and then we have electricity interconnectors. Now, Norway, as Stuart was talking earlier, are suffering from a lack of hydroelectricity capacity, and this week have been cutting their electricity exports. And the UK's main gas supplier is now Norway, by a long way, with LNG from Qatar and the rest of the world as much smaller. But the UK has 3 large regasification plants, which means that it is well supplied with LNG, and its export pipelines to continental Europe are full. So what the UK has been doing is it's been firing up its gas-fired power stations and exporting electricity to mainland Europe. And you'll see here that it's increased its exports this year to Belgium, Republic of Ireland, and Netherlands, and reduced its imports from Norway and increased its imports of LNG. But all this is going to impact UK consumers that are already seeing income squeezes. Now, this is from ASDA, their income tracker, which does not use till data. It uses data from the Office of National Statistics. But they are calculating, and this is something we talked about right at the beginning of the year, that discretionary spending in the UK will have fallen by 18% currently. And we forecast in our calculation a 15% drop. So actually, Portfolio Matters get something right. So what that's going to mean is UK consumers already are going to have to be cutting back on discretionary spending like visits to the pub, which will impact services and consumer-facing businesses. And energy crisis is going to squeeze that further. And this is the history of the ASDA income tracker. You see how it's really come off the cliff since inflation picked up. So in summary, UK is likely to suffer just as badly as mainland Europe from the coming energy crisis. That's further going to squeeze UK consumer spending. And frankly, I just can't see how the UK won't have a deep recession given the impact on consumer spending of elevated energy prices. Stuart, any comments?
Well, it's back to that Bank of England chart, isn't it? That was truly depressing out to 2024, 2025, just very little prospect of robust growth. I know Rishi Sunak has been trying to promote an enterprise economy with his various schemes to support venture capital, but it's unfortunately sort of doesn't really touch the sides of the scale of the problem. To me, I think we have structural issues which need long-term structural solutions, and the politicians are not providing it.
To be fair, I think it's difficult to know what they do now. I mean, structurally, there's a lack of energy, then you support consumer spending and the ability of people to heat their homes, but that means there's less left over for industry. And so, which is going to affect GDP. I mean, we are trapped. The trouble is, we have had a lack of energy policy planning. For example, closing the Rough gas storage facility. And we're now exposed, we have intentionally exposed ourselves to spot markets for our marginal supply. And this is where we are. On to other charts, Stuart.
Right, here's something from the FT about some issues in China where commodities companies such as Glencore have cut their ties with a Chinese trader. Now, this trader appeared to be a good example of what I think Galbraith talked about, the bezel. So the bezel, think embezzlement, of course, which is a time when the person who has stolen your money has that money and uses it, but where you think you still have the money and your wealth is not affected. So there's like a double amount of money, and that is a cause for optimism and growth in the economy. But when the bezel is discovered, that's the hit to wealth and income and expenditure that can be expected. Now, this copper story was a good example of the bezel, where this Chinese trader who was supposed to be looking after copper stocks for various customers appeared to have lent them out, sold them to numerous customers. So everyone thought that they had stocks with this Chinese trader, but not everyone was really able to get hold of the stocks that really existed. So a sign of things to come, perhaps.
Traditionally, recessions reveal the bezel. Think Bernie Madoff.
Bond markets are beginning to show some signs of concern, not particularly about, for instance, autos, given the rise in auto prices that there's been in the States, but about personal loans. We can see here the premium of BBB rated consumer debt over treasuries, which has increased a bit for auto loans, but in particular for personal loans, the yield premium has gone from about 1.5% at the beginning of the year to 4.5%. So certainly some early signs of worry about consumer distress. And senior loan officers in the US are showing nervousness. There's been a tightening in conditions. So not only is the cost of debt going up, but the availability of it in terms of credit metrics is also being tightened.
Yes, and this seems to be a very good leading indicator, actually. If you look at the other times it's spiked, recession has soon followed.
Yeah, and spike is the word, isn't it? It changes very rapidly. I thought this chart was fascinating because I believe a couple of months ago we were talking about the predictive power of the high yield spread. The chart here is the US high yield bond index option adjusted spread, i.e. how much extra yield you get for junk. And we were highlighting some research which suggested that about 6 percentage points yield spread was a good time to buy and was a sign that, in fact, a recession may be over. Well, we seem to have been front running ourselves because that 6 percentage point yield spread did indeed mark the moment of a rally in risk assets. And that has come down to, well, what's that, more like sort of 4.7%. So a very quick rally in high yield bonds and also in other associated risk assets.
Yeah, I'm mystified. Yeah, PMIs are still dropping.
Well, it may be this reflexive thing. You know, we're all looking at the same data and front running each other. Meanwhile, the economy is a rather more slow moving beast. US financial conditions are easing a bit after having tightened, of course, a lot from last December through to around May, June time. Some easing off there.
Yes, I think that mirrors the high yield bond chart we just saw.
Eurozone financial conditions are continuing to deteriorate, however. The US is shown in the white line, but blue is showing a continuation of tight conditions in Eurozone. So again, more evidence of the difficulties that Europe is facing. Moving smartly along to the weekly checklist for equity markets, a pretty good week across the board. The UK all share up by 0.9%, meaning that its loss for the year is now just 1.4%. Europe was up 1.1%. The S&P jumped very smartly, up 3.3%, so it's down only 10% on the year now. Nasdaq also up a bit over 3%. Its loss for the year now about 17%. Hong Kong, that the Hang Seng was the exception this week. It was down 0.1%. Japan continued to rise 1.3% and is down only 1% on the year. That, of course, being measured in yen terms. Bitcoin had a nice week, continuing the risk rally, up 4% on the week. So now it's down just 48% year to date. The pound was up 0.5% against the dollar. The dollar more generally was weak, off about 0.9% on the dollar index. So the S&P has recovered half its losses. Is the bear market over? Well, I think you can tell from the tone of the community of the chat today. There's very little evidence in the economic outlook, at least, that things are improving. It's more a question of awaiting the confirmation of a downturn and a recession. Meme stocks have had another day in the sun during this risk rally. Here we show AMC, GameStop, Bed Bath & Beyond all having spiked. And if you could have got in at the bottom, you'd have made a very nice turn. Obviously, not something that we would be doing. The dollar, as we highlighted in the table a few charts ago, has weakened a little bit. We show here in the black line the US dollar versus the G10, where after having spiked, having risen pretty strongly for the past year or so, has come off a bit over the past month. And it's been less pronounced strength versus the EM, or at least EM ex-China and ex-Russia. Again, a little weakness recently, but still pretty strong in historic context. Right. This chart was fun. This is the gain and loss on investments at SoftBank's Vision Fund. You can see through 2017, 18, 19, pretty steady rise in the reported value of the investments that it has made. Then a reasonably big dip before a huge zoom up, peaking at the back end of last year. Most of that has now evaporated, and I think there's not many observers who are too surprised by this. Some of their bets just seem to be extraordinarily hopeful on extraordinary valuations.
Yes, the valuations were just insane. So I was reading, forget about what name it was, but they had invested at a valuation of 46 billion. And now there's a down round at a valuation of 7.5 billion. Now, even if you had thought the company was worth 46 billion, then surely you want a return. You know, if you're doing essentially venture capital investment, you're expecting a return of what, fivefold, hopefully? Because not all work. So unless they thought that the company could eventually be worth 200 billion, it wasn't worth doing. So I just don't understand the economics.
There's so many extraordinary stories. I was reading cases where they were offering money to startup companies and threatening them, saying, if you don't take our money, then we will go and fund a competitor of yours. So companies were being forced to take more money than even they wanted. It's just extraordinary. Here's the CNN Fear and Greed Index, which is back to neutral. Zero reading was a big buy signal that we discussed at the time, i.e. extreme fear a couple of months ago, and now back to neutral. This was a fascinating chart. This is looking at the cumulative revenue growth of the FANGs, that is, Facebook, Amazon, Netflix, Google, etc. And that's a pretty distressing, depressing reduction in revenue growth, which previously was running at about 40%, is now down into much more traditional single figures. So although quite a few of these stocks have come off in share price terms, as we know, there does appear to be a big change in the fundamentals, that they're not perpetual motion machines.
Yeah, the strong forecast future growth, well, it's evaporating.
Now, Keith, I know, is fascinated by this chart. This is the asset allocation to stocks versus subsequent 10-year returns on the S&P 500. And it is extraordinarily well correlated, isn't it? And it basically saying when stocks are a very large part of your portfolio, then the subsequent returns are likely to be very poor. And given the history of US investors' allocations to US equities, then the outlook looks very grim for the next 10 years.
Yeah, it's forecasting annual returns of less than -1% per annum.
Now, I do wonder about how this is created, because, of course, if the US stock market, for instance, doubled, then, of course, your allocation to US stocks would have increased. So to me, I wonder whether this is, in effect, a sort of overvaluation measure. When US equities have gone up a lot, they form a larger part of people's portfolios. You're basically getting a sort of mean reversion effect in terms of valuation.
Yes, that's exactly what happens, Stuart. So if you go onto philosophical economics, they explain it really well. But basically, if you want to increase the proportion of equities in your portfolio, then you essentially have to bid up and buy those equities from somewhere else. And so you bid up the total value of equities. So in total, investors' overall allocation to equities can only rise by them being overvalued, essentially.
This is a chart showing various bear market rallies in previous overall bear markets. So this is 2000 to 2002, and you can see some pretty strong bear market rallies. It's not at all unusual to see rises of 20% within a longer term downtrend. And I'm pretty sure, Keith, that's your interpretation of the recent rally in markets.
Yes, I mean, I just don't see any, well, I see very little macroeconomic justification for the rally. I think, when the CNN fear and greed index hit zero, you could tell that things were oversold and there was going to be a bounce. Now, the strength of bounce has surprised me, but the direction didn't at all. Okay, thank you, Stuart. On to commodities and energy commodities. So, generally a good week. Brent and WTI both bounced up over 3% on the week and up over 25% on the year. Natural gas futures just continued to grind higher from already astonishingly high levels. So, Dutch natural gas futures up 5%, up almost 200% for the year. UK natural gas futures up 140%. Sorry, UK natural gas futures up 130% on the year. US natural gas futures up 135% on the year, up 10% this week. Coal up 11% this week. Remember last week we were saying it'd come off sharply. Well, it bounced back, up almost 140% on the year. Uranium was flat. Some numbers pertaining to the oil market. Well, interesting. Total US crude inventories, including the SPR, rose by 7.7 million last week. Excluding the SPR, private inventories rose by 13 million. So last week, there was an extraordinary glut in oil in the US, but the oil price bounced. Something to watch. Now, US crude production hit a new record for the year, up to 12.2 million barrels. But again, that's only an increase of 400,000 barrels on the year to date. And forecasts are that we'll see much stronger increases in US production in the second half of the year. Let's see. Baker Hughes rig count rose by 3. So this is crude. Now, thank you to Simon W., who sent me a piece from EIA discussing switching from gas to oil for power generation, both Asia and Europe. That is supporting oil demand. And so the IEA have increased their forecast for oil demand for 2022 by 380,000 barrels a day to 2.1 million. Now, looking at Russia, well, the initial hopes, frankly, that Russian oil production would collapse as all the Western oil service countries fled the country on sanctions, well, they appear to be misplaced because Russian oil production is recovering. And that, combined with very high energy prices, means that Russian energy exports are at record levels. Now, looking at US crude inventories, well, look top left, they're increasing, but the Strategic Petroleum Reserve is collapsing. So we can't keep on drawing down Strategic Petroleum Reserve to keep private inventories, private markets well supplied forever. The Dutch natural gas futures, that looks not like a spike which we saw earlier in the year, but like a grind higher. That's going to get worse going into winter. So UK natural gas futures not quite as bad. US natural gas futures recovering to earlier highs of the year. Coal high, uranium flat. Stuart.
Here we have a look at the industrial commodities performance over the past week. In general, most commodities are showing some small gains. Aluminium up 0.8% on the week. Cobalt was an exception. That was down 4%, is now down 33% for the year. Copper has bounced 3.5%, reducing its losses for the year just to about 18%. Chromium was flat. Iron ore up a bit, about 1.8%. Other notable ones, nickel up 6.5% on the week and now up 13% of the year. Tin had a quiet week, up 0.4%, but still down 37% for the year. And zinc also had a bit of action, up 3% on the week. So looking at that in chart form, here you can see aluminium. The steep falls from around April through to July appear to have stopped. It's now hovering around $2,400, $2,500 a ton. Cobalt continues to fall. It was over $80,000 a ton, now $47,000. Copper has bounced back, I guess, in line with risk assets generally and economic optimism, despite our view about the likely economic outlook. So quite a reasonable bounce for copper since early July. Chromium, quite volatile, not so much recently, but some big changes over the past couple of years. Iron ore, again, a little bit like copper, has stopped its weakness, seems to be looking for some sort of direction. Lithium also has no direction, absolutely flatlining there. Neodymium has been rather weak since the beginning of July, and that has continued. Nickel, as we're pointing out, had a reasonably strong week. It's all dwarfed on the chart by the chaos at the LME back in April. Tin completely flatlining since the beginning of July after having fallen quite strongly since March. Ferrovanadium has come off a bit just recently, but very spiky long-term chart. Zinc, a very strong rally since the beginning of July, has gone basically from about $3,000 a ton to almost 3,700. Precious metals now. Gold had a good week, up 1.4%. Silver, even a stronger week, up 4.6%. Platinum and palladium also joining in the rise with increases of 3% and 4% respectively.
Yes, it seems that the precious metals have suddenly become risk assets as opposed to safe havens.
It's depressing, isn't it? My little gold exposure by gold producers and gold itself was supposed to be exactly that sort of contrary or sort of ballast to the portfolio to give myself some negative correlation with risk assets, instead of which it's doubling up. Well, here is the gold chart, and as Keith was just saying, it's become more positively correlated with risk assets, having risen from $1,700 an ounce to $1,800 in the past couple of weeks. Silver, very much the same pattern, a bit of weakness at the beginning of July, which is completely reversed, and going from about $18.50 an ounce up to almost $21. Platinum, same sort of story, a big bounce in the past few weeks. Rhodium, however, not so much. It seems to be middling around at about $14,800 an ounce. Not too much change there. Palladium, much like silver and gold, a bit of a bounce over the past few weeks.
Yeah, thanks, Stuart. Okay, on to rates. And we had, frankly, a bit of an odd week in markets in that the weak US CPI print you would have thought would have been good for bonds. Lower inflation equals better for bonds generally, but instead the lower CPI print seems to have ignited a risk-on rally and safe havens sold off. So you see that the whole of the UK yield curve shifted upwards, had a rise of 10 basis points in the 2-year, 13 basis points in the 50-year. Now, in the Eurozone periphery, yields also rose, but not by much. So Greek was up 17 basis points, Italian 10-year up 5 basis points. Now, I thought this was really interesting from Robin Brooks. It shows that Italy is entirely dependent on the ECB to fund its fiscal deficit. Essentially, the ECB, via the Bank of Italy, has been buying all new Italian bond issuance. This is a chart we showed last week. But I thought this tweet from him this week was really good and shows the conundrum the ECB is in. So, Italy is very highly indebted, needs low rates to be sustainable. But, as you see from the last chart, private investors won't buy Italian bonds at low rates. So, the ECB is the only buyer. And at low rates, Italy has no market access because no one apart from the ECB will buy Italian bonds at those rates. Therefore, the ECB is buying all the Italian bonds, which means Italy has no incentive to change. So it goes on. ECB is trapped. It either continues to buy these bonds or there'll be a crisis. But if it continues to buy the bonds, then Italy has no incentive to change.
So tough love is needed. Is that the bottom line, that you need to induce a crisis?
Well, I just think the Eurozone has been very badly set up. The answer is yes, Stuart. But there's a carrot and a stick, and the ECB can't use the stick. So you keep on going until Italian indebtedness becomes completely unsustainable and you can't kick the can down the road anymore. We've been saying that for a while.
Yep.
So, of course, the ECB has been selling Dutch and German bonds to buy Italian and Spanish ones. And that means German 10-year yields are rising. As Italian bonds are flat on the week, Greek bonds ticked up a bit. UK bonds rose on as the market went into risk-on mode. US also slightly. And onto the seasonality chart, well, we are in peak summer buying season now. Doesn't improve from here. So finally, concluding comments. Well, we remain in the dog days of summer. Markets will be volatile on low liquidity. I've said this for a few weeks now, and it remains true. And I think you should look at the rally in risk markets in that light. And the low inflation print in the US this week seems to have revived investors' animal spirits, but I see very little in the macroeconomic picture to justify that optimism. Fundamentally, ignore the noise. Just look at the housing cycle. As we have discussed previously, the housing cycle in the US is turning down, and with a lag, the US economy will follow it. And Europe and the UK, the energy crisis is here, and there will be a respite when we get some rain, which allows more hydroelectricity and reduces the need to burn gas for air conditioning, etc. But then, after a few months, go into a proper crisis when temperature turns down with winter. And on that cheery note, Stuart, what have you been up to this week?
No activity from me in the past week. The portfolio itself is up a little bit compared to when I was on last week, given the continued rally in risk markets. The only comment I was going to make was back on some tax-advantaged investments where I've previously been speaking about enterprise investment schemes and venture capital trusts. Well, a few of the venture capital trusts that are focused on the AIM market look like they're going to be raising more money over the next few months. And given the very poor performance of AIM, those are quite interesting, I think, sort of counter-cyclical or contrarian bet. Quite a few of the other venture capital trusts which have private investments have not marked down those investments. So they're probably going to be priced at a rather optimistic NAV, whereas the AIM-focused VCTs can't avoid the markdown that there's been in markets. So possibly something of interest to look at over the next few months. How about you, Keith? How have you been doing?
Well, I'd say just on the VCTs, buying a good trade at some stage, not yet. Okay, thank you, Stuart. Well, I had a bit poor week. Down 0.6%. Frankly, I was expecting it to be much worse than that, as the CPI number prompted a risk-on rally, which was bad for safe havens like my bonds, but also bad for the US dollar. I've got most of my assets in US dollars. So I was down 0.6%. Your share was up 0.9%. So I underperformed by 1.5% for the second week in a row. But I was still having a good year. Now, one of our Discord members, James Battle, was asking me what would cause me to change my mind about my big position in US government bonds. I would have to see an end to the Eurozone UK energy crisis. I can't see how going into what is going to be a generationally bad energy crisis can be anything but extremely bad for Euro and sterling. So despite a few weeks' losses, I remain very much committed to this trade. No sells, no buys. This is my asset allocation, and it's almost all in US dollars. And Stuart talked about time in the market, and this is evidence of my timing the market. So you'll see my bond allocation goes essentially from 50% in 2020 to 0 to back up to 95%, whereas my equity allocation goes from pretty much 100% over the course of the last year to 5% now. So the way I manage my portfolio is I very much attempt to time the market. See, it's my bond allocation. See that I have been increasing my allocation to US long-term bonds. But they had a bad week. This is the price of US Treasury, 2% 2051, down on the week, as was the other bond I hold, 1.875. And it was also a bad week for long-dated UK gilts, which, having recovered a bit, I got optimistic but seen the worst, slumped. So that's it. Next week, it will be business as usual, and we'll be having the podcast on Friday morning, and it'll be out by Friday night. But then I am off on holiday again, and we will miss for 2 weeks. I will be available on the Discord. But in the meantime, thank you very much for watching to the end. Please can you press like and subscribe to the channel. And it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.